So we're again today talking about purchasing long-term care insurance and life insurance with a single deposit of IRA money and postponing some taxes on distributions. So you say you're talking about it again. I mean, one of the neat features of this whole arrangement is this money coming out of the IRA to pay for the life insurance long-term care qualifies as your RMD, or required minimum distribution, which for most of you don't start till 73. But that's why we've made an example today of two people buying long-term care insurance with their IRA money that they're age 73. So we do have some clients come to us when their first time they're coming in is they're facing minimum distributions. And that's the matter that brought them in our door. And so we're planning out their RMDs, because these RMDs do nothing but grow between now and the end of your life. And what we do a lot is we end up showing them this long-term care insurance. I also want to point out you have to qualify for this long-term care, but we have many people buy this in their 70s. So I want to put this to Tom, and I want Tom to share with you why we're doing this video today.
Yeah, I mean, we're doing this video because of all the planning that we do in all these different areas. This is the one that will have the most impact on your lives or your kids' lives. Because if this happens, if a long-term care event happens, your world will be upended. Everything will change. I mean, I've lived this. If you've watched the show, you know my story a little bit, but I've been through this and I've seen it with client time after time, where this just upends everything. Is it changes your life, it changes your family's life, your kids' lives, everything gets put on hold. And so we really take this seriously. We want to plan and having something in place to take care of long-term care if this does arise. And so that's why we're doing the video. Let me bring up the show notes. Again, you can find these at the link below our video. They're also on our website at cardinalguide.com. We have the board, and then we have the illustration of the policy we're going to talk about. I'm not going to spend a lot of time right now because I think we can go through it on the board here. But after you've watched the video, if you have more questions or want some more information, you can go get the full illustration of the policy that's represented on the board. So let me turn it back to Hans, and we'll sort of go through the features of the policy.
Okay, so you'll notice again, this couple are both 73. So, and this is coming out of his IRA, but it's covering both of them. And he is right at minimum distributions. So, and we're talking about $300,000 in his IRA, just moved to another IRA at the insurance company. So this is not going to be a taxable transfer. It's going to be a rollover. We're going to take $300,000 out of this, move it over to the IRA. And then it's going to be taxable year by year for 10 years. So I'm going to get into the explanation of the policy, but that's the only premium you're going to pay into the policy. And I really want to show you and focus in the beginning here is what do you get for that? Okay. Why would you want to do this? That's a pretty good sizable amount of money. And the policy benefit starts as if one of these people or both of them went and needed care right away in the first year of the policy is about $6,400 a month, but that they qualify for. If they needed it at 93, it's $9,500. So the policy grows a little bit every year for inflation. So if you increase that, so those are the amounts that is available. And when we go over these numbers and we sell this policy to people, one of the first questions that we get is, well, what do I have to do to qualify? Does everybody get that money, or what needs to happen? And what I want to take you to is the policy. You need to meet or need human assistance with 2 of the 6 ADLs. And ADLs are activities of daily living: bathing, dressing, toileting, transferring, continence, and one other one. And typically, for home health care claims, when people come to us, we're a lot of times the first people they call, and they say, gee, I think I need to use the policy. What's the qualification? We're going to use it at home, and we're going to get in-home care. And what a lot of times I'm going to recommend is we use bathing and dressing as the qualifiers, because they're the easiest to prove. and they're the easiest to just get documented. I mean, if you need help getting dressed or you don't, it's one or the other. And if you need assistance getting dressed, that meets one. And if you need help bathing, getting in the shower, getting in the bathtub, running the water, you got fall risk with that. You can need help getting toweled off. I mean, those are the two easiest of the six. In other words, just to quantify for people that are right on the borderline. So I don't really want to twist people into this situation to make it look like they need that. I'm just simply saying, if you're into one of those starter claims and it's for home care, those are the two, bathing and dressing. So, and then there's the or, and the or means you don't have to meet the ADLs if you have severe cognitive impairment. So if a person has reached a point with dementia, loss of memory, whatever the diagnosis is, if it's certified by a doctor that it's a severe cognitive impairment, then you're eligible to collect the benefits under the policy. So I want Tom to speak to that just a little bit before I go on to some other features and benefits.
Yeah, I mean, I think that it's important to know when you're getting into a policy like this of what triggers the benefits. And this definition, what triggers benefits, that is standard across essentially all long-term care policies. It's really written into the tax code, and a little bit more detail than you want there. But at the end of the day, that's what needs to happen to qualify for benefits. And like Hans had mentioned, when we're looking at the activities of daily living, some of them are subjective, right? It's not really clear cut. And that's why he mentions the bathing and dressing are pretty easy to document. They can't be questioned from the claims department of these companies. And so that's where we focus a lot of times, but not always, right? It just depends on the situation, what the person's going through. But again, that's that. And then the cognitive impairment, what's nice about that is a lot of times the highest leading for reason for claims on long-term care policies is cognitive decline, Alzheimer's, dementia, those type of diagnoses. And a lot of times you're still able to do those activities of daily living. Like you're still be able to function. You just need help because you don't really know what's going on, or you're starting to lose your handle on keeping track of different things. And so it's nice that that's included in there. It really prevents the issue of someone needing help but not being able to get benefits. So I'm glad it's there. Again, it's standard across essentially all policies, so it's not unique to this particular company. And again, I think it's, like I said, when you're getting into the policy, it's helpful to know what triggers those benefits.
Now, then listed here it's talking about the setting you're getting the care in and who's providing the care in that setting. You've got informal care, which really means your family or somebody, your neighbor, somebody that is helping you that perhaps isn't professionally trained. They're not billing you through a proper agency. This policy has a benefit for that to pay. It also talks about home care, which you're going to hire through an agency. And there's a lot of latitude in how that's delivered, when it's delivered, the number of hours, that type of thing. It covers nursing home. Obviously, this is the first place people go when they're talking about this kind of injury. I don't want to go to a nursing home. Well, you don't have to collect from this policy. It'll certainly pay if you go there. Most of the long-term care, most of the long-term claims don't happen in a nursing home. They happen in an assisted living or adult daycare or home care. Adult daycare, which is where maybe your kids are taking care of you with informal care during the evening, at night, and then they take you to the adult daycare during the day while they're working. So I want Tom to just talk about that a little bit.
Yeah, I mean, I think when you bring up long-term care or long-term care insurance, their mind immediately goes to nursing home. I mean, and it's just natural. But the point I make is that a lot of care, or a lot of the reason you're buying this policy, is to keep you out of a nursing home. It's allow you to stay at home, go to an assisted living, somewhere that's more comfortable, that you feel, you're more comfortable receiving that care. Your kids are more comfortable you being there. A nursing home a lot of times is the place of last resort. If you spent through all your assets, you haven't done the planning, and you're relying on the state and Medicaid, they only pay for nursing homes. So a lot of people go to nursing homes because they have to. That's the only place that the state will pay for them to receive care. And or there are health concerns. There's some health diagnoses, things that happen that you need to receive care in a nursing home because it's the only safe place to receive that. But other than that, most people really would rather stay at home, go to an assisted living, something under those lines. And what's nice is this policy pays for all of the above, right? Is you have some options. It's not pigeonhole you into just one of those things, and you get to pick. Like the company isn't coming out and saying you have to go to this particular place or you have to use this agency. They will use all of the above, and you get to interview the ones, find the one that meets your needs, your family's needs the best, and go with that. And this policy is really just there as a funding mechanism, helping pay that bill if you have to go there.
Okay. Now, there's a 90-day elimination period, which is like a deductible. In other words, the first 90 days you're in a facility are not paid by the insurance company, and then the 91st day is. And that's when you go directly into a facility. That's your first claim. Now, if you use the policy at home for home care, there's a 0-day elimination period. So the insurance company here is encouraging you to get the care at home because they're going to start paying from day one. Now, an important point to understand with that is if you start at home and you use it for 90 days or more, then you're going to have no 90-day elimination period when you ultimately transfer to a facility, if that's how it works. Tom?
Yeah, I mean, I think that last point that Han just made is really critical, right? It's a lot of times claims will start at home, and things might get worse, right? Things progress. But what's nice about this particular policy is those days that you receive care at home count towards those 90 days that you would need to have met in a facility. And so if you're at home for 90 days, again, there's no elimination period for home care, so the benefits start from day one, and then you transition somewhere else that you've already met the 90 days, that coverage just will continue. If you do have to go directly into a facility, there's some acute thing that happens, you go to the hospital and then they transfer you directly into a facility, you don't go home, you've not met it previously, there is that 90-day elimination period. Medicare might pay for a portion of the beginning days. They're not going to, likely would not cover the full 90 days, but Medicare will pay for potentially some of it. But there would be some days that you would likely have to pay for yourself. Again, that's just how the policy is designed. But like I said, most care starts at home. That's, again, no elimination, and then that counts towards that. The other thing to know, which is different than a deductible. So your health insurance on the deductible, that resets annually. Each year you have to re-meet that. The long-term care policy, the elimination period is lifetime. Once you've met that once over the life of the policy, you never have to meet it again. So if you were to go somewhere, meet it or get care, say you had a hip replacement, something like that, you needed care at home for a certain amount of time, it got better, you didn't need care anymore, you're living on your life, and then you need something in the future, you don't have to re-meet that. Once you've met it, then you're good. So that's just something to keep in mind.
Okay. Then I want to highlight this unlimited lifetime benefit. And, there's two people covered under this policy. And where this really comes into play is when one of them or both of them end up with cognitive, there's no 3-year, 4-year, 5-year maximum per person of usage. And a lot of people say, 80% of them are taken care of in 3 years or something like that. Well, yeah. Well, what about the 20%? Or even the 10% if you're looking at a longer period of time? Just the fact that it's unlimited gives you the peace of mind of knowing that if you purchase this policy, both of you are covered on an unlimited basis for the rest of your lives. So there's a lot of comfort in knowing that. So now we've talked really here about the benefits of the policy or the long-term care portion. What I want to do is I want to move over. So what do you have to do to get these benefits? And the policy itself, where you would pay $37,500 a year for 10 years, is available all by itself. So, you don't have to use the IRA thing to buy this because it's two policies. I mean, it's two policies from a company. One is what you roll over the IRA from where it is to where it is now. The other policy is the long-term care life insurance policy. So you could purchase these exact benefits by paying $37,500 a year for 10 years. But the whole reason for the example here, with both being 73, was to use the IRA. So I'm going to show you how the example in the illustration looks that's in the show notes. So we would do this $300,000 IRA rollover, IRA to IRA, and then the company would credit you with $75,000 worth of bonus interest because they're going to be holding this money in your IRA, at least parts of it, over 10 years. It's going to be empty over 10 years, at the end of 10 years, or a total of $375,000 in the IRA. And 1/10 of that amount, or $37,500 distributed each year for 10 years, that's distributed directly into the life long-term care policy. And so what that does is it creates an RMD. So that counts as your required minimum distribution. So I was killing two birds with one stone here, is we're getting long-term care insurance and we're buying it with a single premium out of the IRA, which is where we have our largest accumulation of money in a lot of people's cases. And then we have an RMD that's due at age 73. And so this $37,500 that's coming out of there right away and coming out every year for 10 years is going to count toward that RMD. And so that's about it to it. The funding gets a little bit confusing. So it counts toward the RMD. If you still have other money in your IRA, if you're putting 300,000 into this, the assumption is you've got more money sitting in an IRA. There's this thing called RMD aggregation across all your IRAs. So you're able to take this amount out of this IRA for 10 years, and whatever's not used up by this, you can count towards some of your other RMD. I mean, that's helpful.
I want to jump in there just real quick, and to give some context here, is at 73, the RMD percentage at 73 is just under 4%. It's like 3.77%. And so let's say you had $1 million in the IRA, just for this example. And you might have more, but let's just section off $1 million of it. We're taking 300 and putting it in this policy, but that relieves 700 outside of this that's still invested, still doing whatever it's doing. That 37,500 is enough to satisfy an RMD based off $1 million IRA balance without having to touch the other money. So this is able to satisfy that while the other money is growing and we're not having to make distributions out. Now, if you have $2 million in your IRA, this takes care of half of the RMD issue, right? Just simple math here. Again, these are rounded numbers. It's not exact. You'd actually want to calculate all this to be exact when the time comes. So don't base your RMD based off what I just said there. But that gives you an idea of how much that RMD aggregation can help, allowing you not to have to touch that other money.
Okay. It transfers, the 37,500 transfers to the long-term care life insurance policy. I mean, it's just that simple. It goes on internally. Now, you're going to get a 1099 at the end of every year for 37,500. So you're going to have to come up with the tax money to pay on the $37,500 distribution out of separate funds. Now, the IRA is empty after 10 years. So by taking this much amount, so by the time this couple is 83, I mean, they're not going to pay any more into it, but all the 37,500 transfers have happened, and all the money is now over in the long-term care life insurance policy. You pay tax on the 37,500 annually. I already went over that distribution. So it's a little bit complicated, but we're killing two birds with one stone. We're taking 300 grand out of the IRA, moving it by direct rollover, not taxable now, into an IRA at the insurance company. It is the IRA at the insurance company specifically is designed, and it doesn't change, to spit out 37,500 a year for 10 years into the long-term care life insurance policy of which if neither of you use it for any long-term care, neither of this couple, there will be a $153,000 death benefit paid to their heirs. Okay, so there's some of the money's returned. And now I just want to point out is if you've watched these videos before on a similar policy, a lot of times this $300,000 number is $200,000. And the reason that is that both the people are 65 and you can get similar benefits at 65 for 200,000 couple than you would for 300,000 of two people age 73. I also want to point out we have lots of people in their 70s buy this policy from this company. And some of them use IRA money, some of them don't. If you're an inherited IRA person, so you're a beneficiary, you've inherited from your parents, you're under the 10-year rule, and you're probably younger than 73, we can use that 10-year rule or the distribution where you have to distribute that inherited IRA over 10 years to buy this exact policy on you and your spouse. So we can cover both of you, even though you're the only beneficiary. And you're still building up a cash value inside of the policy. So it's not, but we can make the size of the policy exactly equal the amount you inherited in the IRA, and then the benefits will just depend upon that. So there's lots of uses for this combination of IRA and then the long-term care life insurance, the hybrid policy. Tom?
Yeah, I mean, I think that, it's a very unique policy. It's the only one that is on the market that offers joint benefits that is able to be funded directly with IRA money. It's the only one that exists. And then the lifetime benefits is really unique too. And so, again, the lifetime really prevents, one, you ever running out of benefits, but two, since it's a joint policy, you using up your benefits and then your spouse is left with none. And so I really like that feature. And again, this isn't right for everybody, but it needs to be in the context of a larger plan. Because at the end of the day, if you needed the 300 to live off of to create an income, then this wouldn't make a lot of sense for you to do it. But if you're in the situation where you have this money, you don't need it for an income, like you're kind of set, and you haven't done the planning for long-term care, this is a really smart thing to do with a portion of your money. It's not with all of it, but just take a portion of it out, really cover this biggest risk that you face in retirement, and it really protects your family, because that's who ends up bearing the burden of this if it happens. It's your loved ones, it's your spouse, it's your kids. Those are the ones who pick up the pieces and trying to figure out the care, and a lot of times providing the care themselves if the plan isn't already in place. And so I think that this would be very smart for you to consider if that describes you.
Okay, and understand with this, once this policy is issued, no premium increases on the long-term care portion or any portion. Nothing changes. So you get the policy issued, interest rates change, the company's paying out too much in claims. None of this business you read about of rate increases on the internet about long-term care insurance doesn't apply to this policy. Now, I want to go over in terms of comprehensive planning, as we said in the beginning, this is some of the most important work that we do, is as I get the satisfaction, we get the satisfaction of knowing that we've really helped people if we've impressed upon the need for them to rearrange their money and such that they get some coverage for this. So we've talked about long-term care, and we've married it with the 401k IRA money. So if you're still working and you've got your money in your in your 401k, or even if you're not still working, you've retired, but it's still there, we can do an in-service distribution to create the rollover to buy this policy. And if you're in your 60s, we're not going to need this much money to buy similar benefits. We've talked about your income from the standpoint that this $37,500 a year will be income. We talked about your estate from the point that there's a death benefit on this policy. And again, you use that up first for long-term care. So if either one of you uses it to any extent, there's not going to be a death benefit there. But for people that are, that never use the long-term care, there will be. And then we talked about income taxes, because any money coming out of an IRA, you're going to have to pay taxes. So I'd like to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.